George of the jungle, strong as he can be.
What do you mean? My student loan payments are making my debt ratios too high? I don't have any student loan payments. That's what we're going to be discussing in the creditjungle.com today. This is George Anderson. Thanks for dropping in. And with the COVID-19 and everything that's been going on, there's no interest, there's no payments on student loans through the end of 2020. So there's a lot of millennials that are now making up a huge part of the first-time homebuyer market out there. A lot of them have student loans. We know that there's $1 trillion+ of student loan debt out there. And so obviously somebody would think that if I don't have a payment, if there's no interest on it, why would you count that into my debt ratios? Well, for those of you who have federally insured student loans, that doesn't mean that there's not going to be a due date at some point down there. So each of the agencies have come up with different formulas on how to calculate these debt ratios for the student loans. And I'm not going to go into the weeds with every single part of it, but I'm just going to point to a little chart here that I put up that just goes over the surface on a few things here. But the main point that I want to get to is that there's very, very seldom going to be a situation where we don't have to count something. And it's going to be based on the balance owing on the student loans. So let's just talk about this for a little bit and try to make some sense out of it. So the four main types of loan programs that we're going to be dealing with is your conventional loans are going to fall into either Fannie Mae or Freddie Mac. And then we're going to have FHA, VA, and then USDA loans. Each one of those has a different way of looking at student loan payments based on whether or not they are what is showing on your credit report or what is showing on your student loan statement. Okay, you might have a statement that says 0, but your credit report could show something else. Initially, the lender is going to look at the credit report, and a lot of loan officers are going to make the mistake of just assuming that, well, the credit report says there's no payment on it. When you import it into the system, it doesn't bring in any of the debt ratios, and a lot of loan officers have made the mistake of assuming that that doesn't mean there's no payment on there. There's going to be a payment. So we've got a credit report statement, or we have 0, and then I'm lumping this into an other category here because there are different status on here. We can have them deferred, we can have them discharged, we can have them canceled, we can have them in forbearance, and we can have them in a forgiveness status on there. Each one of these has a little bit different treatment depending on which type of loan you're going to be in here. So again, that's why I've got on here a couple of these it depends, because I don't have time to get into it here in a short video. But for the most part, what you're dealing with here is that Fannie Mae and Freddie Mac on a conventional loan, for the most part, will allow you to use the payment that is on the credit report or that is on the statement. But if it shows 0, or if you're on some kind of an income-based repayment plan, which is the IBRP here, Fannie Mae is going to require 1%. So if somebody has a $20,000 student loan debt, what that means is that we're going to impute a $200 per month payment into your debt ratios. Now, here's the nice little difference between Fannie Mae and Freddie Mac. Same person has 0 on there. What if somebody has $100,000 of student loan debt? Not too uncommon. Well, on Fannie Mae, we'd be hitting them with a $100,000 payment, but Freddie Mac only says we got to hit them with a 0.5% of the loan balance as a monthly payment. So this is a situation here. Now, the borrower is just applying for a conventional loan. How do they know whether they're getting Fannie Mae or Freddie Mac? Well, the loan officer knows, and it's their job to know when they submit the loan for underwriting to ask the underwriter to underwrite it to Freddie Mac guidelines and to lock the loan, lock the interest rate in the loan program under Freddie Mac guidelines so that you can use this. And I've had a couple of deals this year where this has been the difference maker on here to count that. And then FHA for the most part is 1%. VA probably has the most flexibility on what they will do. They will actually, if a loan is in forbearance, and if it's in forbearance for more than 12 months, you can actually have some situations where you can count a 0 on there. Or they have their other formula here where you would take the loan balance times 5%, divide it by 12. It ends up being about 0.4%, actually a little bit less than the 0.5% on there. And then again, USDA has some variations on here. So I don't want to get all involved with this, but there are actually a pile of underwriting guidelines that allow us to look at your statement, to look at your credit report, to look at the remaining term on the loan. Look at the circumstances under which you might be in a cancellation, a forbearance, a forgiveness, or whatever it is. And believe it or not, there is a volume with each one of these agencies on how to treat your student loan payment. So the main point here is don't assume because your credit report shows 0 and your statement shows 0 that your student loans are not going to be a factor in calculating your debt to income ratios. So remember, if you have any questions, push button. It's that little subscribe button, I think, right down there. Get Mortgage Professional. This is George Anderson. This is thecreditjungle.com, and I would love to talk with you about your situation. Have a great day.